Yesterday, we had legendary investor Stan Druckenmiller at the Economics Club saying that the prospect for a V-shaped recovery is, in his words, a fantasy. Speaking at the event, which was hosted, as I say, by the Economic Club of New York, Druckenmiller said the risk-reward for stocks is maybe as bad as he's ever seen, but be careful to bet against the market because, in his words, the wild card here is the Fed can always step up their asset purchases. Druckenmiller says the Fed's moves in March to shore up the markets were puzzling and aggressive. To talk more about the Fed's role in the markets, we're joined now by Bob Diamond, CEO of Atlas Merchant Capital. Is this your quote? No, maybe it's Steve's quote, Bob, that the Star Trek Fed goes where no Fed has gone before. I guess we know that's to be true. Was it warranted? Was it too aggressive? Was it puzzling? What words would you use to describe it?
Huge, unprecedented. But I think, Joe, I'd also use the word critical. And, I look back to kind of the playbook that was developed during the financial crisis in 2008 and 2009. And relative to the actions taken then, the Fed was very, very fast to act. The breadth of actions are significantly broader than they were in 2008. And each of these programs is pretty much uncapped. We haven't heard the Fed mention any amounts. So the size, the breadth, the speed is unprecedented. It's incredibly impressive, and I think it's critical right now.
You've been watching the bank stocks, Bob, just in the last couple of weeks. You got some explanation of what's happened there. They're not doing nearly as well as the overall market. Is that portending a lot of loans going bad with companies?
Well, I think, what are the positives, particularly here in the U.S., relative to 2008, the banks are clearly much safer. I think they're much larger as well. And I think one of the interesting indications I look at is the relative performance of the large U.S. banks versus the large banks in the U.K. and Europe. And because of the actions of TARP and many other things that were done in the U.S. markets in 2008 and 2009, we saw that outperformance for a long period. Well, that outperformance has picked up, since this most recent market dislocation. So the U.S. financial institutions may be kind of behind the overall index, but they're ahead of their peers in the U.K. and Europe.
Huh. Okay, so bad relative to the S&P, but better compared to their peers. But is it signaling anything about how difficult the environment's going to be for either consumers or companies that they do business with, or yield curve, or what's in it, do you think?
So I think as you look forward, particularly as we look at the larger U.S. banks, they're very, very safe. The capital levels are much stronger than the period in 2008 and 2009. But the lower interest rates are certainly going to impact earnings. Yeah, I would say that's part of it. But part of it is in the index, you have some tech stocks that probably have a better future than the banks.
Do you, at this point, you've seen, they said it was dead on arrival, but the latest stimulus that we're looking at are from the Democrats, which is a non-starter, supposedly, but it is adding up, isn't it, Bob? Are you an MMT guy, or do you have any concerns about the amount that we're throwing at this and whether that ever comes home to roost?
I think what all of us are waiting for, Joe, is when is the right time for kind of a very careful, very measured, very coordinated, reboot of the economy. And obviously that's very complex, and the timing of it is very, very important. But I think for any of us to act surprised at the kind of numbers we're seeing in the economy, I think the UK numbers today came out, and the economy was down something like 5.8%. Well, we pretty much closed the economy for appropriate reasons. So those numbers are understandable. And I think the focus should be on the most important thing is getting something that's very, very careful, very measured, very coordinated, very iterative and incremental to get the economy back, taking into consideration that we have to do it in the right time.
Well, Bob, I remember the financial crisis, and, we had stimulus that people didn't like. It was less than $1 trillion, I think. And then, the balance sheet, the Fed's balance sheet expanded. But now look at what the latest stimulus being added to the economy from Congress is, the fiscal measures, and look at what the Fed is doing. And it's got to be a multiple of 10 to what we were so worried about in 2009, 10, 11, 12, and this coming due, and this isn't free, and we got to unwind all this. I mean, it's 10 times as much now. Why aren't you more concerned, or why shouldn't we be more concerned that it's just going to be really difficult for all of us to deal with this, and bad for growth, in overall growth in the economy when we have so much debt service?
Well, as I said, Joe, I think the speed with which the Fed acted and the breadth and the size is incredibly impressive and critical. But you can't, we're not going to do everything with monetary policy. And I think fiscal policy has to go alongside that. The area that I feel the focus should be on is small businesses. And even with the PPP program and others, over 60% of the small businesses in the U.S. have had to let people go. And so focusing this on lending into small businesses, to me, is the most critical part. But I am supportive of fiscal alongside of the monetary for sure.
Andrew.
I had a question that may sound unrelated to business, but we had you on probably a year and a half ago with the head of Colby. You're a trustee of Colby, and I was curious if you have any updates on, or what you know about the timing of whether people are going back to school and what you're hearing on that front, and also all the seniors who are trying to get jobs. What's going to happen?
So we're cautiously optimistic. David Green and the trustees are very, very focused on doing what we can to provide in-person education to our students. And this program has to be very thoughtful. There have to be a lot of health aspects to it and testing aspects to it. But one of the things that we've decided is a leadership of the college and as a board of trustees, that even if we had to delay the first semester as late as December or January, we could still run a full year of in-person education. And the second thing that David has done, and this is where leadership really matters, is he's gotten 30,000 alumni and thousands of Colby parents to commit to getting jobs for every one of the seniors in 2020. And we have a very large number of those seniors that, for various reasons related to the market dislocations, don't have jobs right now. So he's mobilizing us very well.